Good to meet up again, Will. We've just come out of the investment committee meeting with some of our team who've dialed in, and obviously your team as well. Really good meeting, I thought, in terms of what we covered off and changes that are coming down the line. Maybe just talk about how our investment committee works. I think some of our clients might want to understand how the rationale and the relationship works.
Yeah, absolutely. So we meet at least every quarter. Occasionally we'll meet on an ad hoc basis if we need to. We will be presenting a pack, which is a very extensive pack to show all of the market performance. So we'll talk at the beginning about what's happened in markets, the context of where we're at. We talk about the changes that we recommend, which we think for forward-looking basis, how we think we should evolve the portfolios. We look at performance and risk to make sure the performance of the portfolios are running exactly as we'd expect. And then we can look at every single level of detail we want from an asset allocation perspective, the weighting in each fund, the performance of each fund. So we have a very comprehensive pack that we can go through and cover every single point to make sure that we cover everything that we need to cover.
Okay, and we've just gone through this process of giving you a little bit more leniency in the three pillars that run through our portfolios. Our clients are well versed with the sustainable element, the active and the passives, and we've just given you guys a little bit more flexibility with that. And if you just maybe try and explain how that will help the portfolios moving forward.
Yeah, absolutely. Well, first of all, just to say on the three pillars, we think it's a brilliant way to come at trying to run portfolios because you have the natural diversification that each pillar brings. So passive will always have a large number of holdings within there, the whole index, whereas active will be obviously more tailored towards whatever the particular way to exploit those particular markets, and sustainable has its own tilts as well. So we like the three approaches for diversification because our first objective is to make sure these portfolios are as diversified as possible, and those three pillars ensure that. But the ability to move between the different pillars, between, say, active and passive, gives us another way to tilt the portfolios for the current environment. So in a year like 2024, the biggest winner in markets was the S&P 500, so the biggest index in the US. And so that passive holding was the big winner that year. Whereas in a year like 2025, the way it's shaping up, clearly much more uncertainty, and maybe we'll talk about that more later on, much more uncertainty. And so you want to be able to have more inactive management, which is able to tilt away from maybe certain areas of risk and towards certain areas of opportunities. And so that approach, that being able to move and have all slightly wider bands and just always being exactly a third, allows us to do that.
And I guess at the moment with what's been happening over the last sort of month or so, that ability to pivot from pillar to pillar has been really useful.
Really, really useful, and it's as I say, we've been more inactive than in the last few months because there's been opportunities both in equity markets, which is very obvious, but also in bond markets, and so that ability to change, and of course under the surface, those active managers are making changes, responding to the environment, which is of course also very important.
Yeah, and in the pack that you send us, we've obviously got the star performers in the portfolios, and we also, with that, there's obviously, because of the diversification that we have within the portfolio, you're obviously going to have underperformers a little bit in terms of where they are. So we spoke a little bit in the investment committee meeting about the funds that have done really well. Just talk to us a little bit about those funds and how they get selected.
Yeah. Well, first of all, the selection process is really, really important. So we have a team of analysts who look for the very best managers within each specific field, and we monitor those. We review those on a regular basis. We monitor their performance every month, and what we're looking for is to make sure they're delivering on what we would expect, which is outperformance. Obviously, that's important, but also to make sure they are behaving in the way we would expect them to, that they're not moving, say, into small companies when they say they're investing in large companies. That's really, really important. And then in terms of the winners, well, actually, if I look at maybe just to go back a bit further from when we started, it's quite surprising as to who's done really well. Actually, the best two performers, just to highlight the winners first of all, have been two active managers, which is maybe surprising some people because people think that passive has been the big winner. In fact, since we've been working together, it's been two active managers, and they've been in the UK and Europe. I think a lot of people might be surprised by that because I think the UK has been a poor place to invest. In fact, it's been, if you've been in the right areas with the right active manager, it's actually been really positive. Actually, all of our managers have been positive over the period, which is also quite interesting. One of our other strong performers has also been a bond fund manager. Active management in bonds has also done very well. Obviously, the S&P tracker was the big winner from last year, but actually, when we look over the full period, it's not done quite so well. And one of the things we did in the portfolios a couple of quarters ago, so 6 months ago, was to move away from just tracker funds into what we call equal weight, where we're making sure the portfolios are more diversified, owning every company in equal size rather than weighted by market cap. So the list is maybe not what some people might imagine, and that's what we want. We want that blend of performance. There's always going to be some losers every quarter, of course, but what we want is it's the average that's so important, and that diversification. You don't want everyone winning one quarter and everyone losing next quarter.
Yeah, I'm going to put you on the spot now, and then I think a lot of our clients are nervous, as most people are, about what's coming down the track. What's your thoughts on what that might look like over the next 6 months?
Well, we like difficult questions. That's definitely a difficult question. I mean, what I would say is how we've been talking at the beginning of this year or end of last year before the election, the US, the biggest economy in the world, was in a great position, growing at over 2%, no signs of a slowdown. So we started the year in a really strong position. Now, obviously, the US administration, Trump has been elected, and he has started with a bang, both causing huge amounts of uncertainty that everybody's aware of, changed his mind a lot, causes more uncertainty. So predictions are more difficult than normal. We have to acknowledge that. So that's one of the reasons that we think diversification is so important, because it protects against that uncertainty. You can't avoid uncertainty in markets and in life. So where are we today? We would say today the economy globally is still in reasonable shape, but they're already starting to show some of the impacts of these tariffs, particularly the uncertainty around those tariffs. And as we're recording this, Trump has paused some of those. He's increased the trade war with China, but he's paused and reduced some of the tariff rates for some of the rest of the countries. And we've got 90 days where he's going to work out what he's going to do, whether they're going to be able to negotiate tariffs. We think that's quite difficult to negotiate that many tariffs in 90 days. And so I think the year is going to be more uncertainty. If he leaves them in place, we think the environment is going to get more difficult. The US, we think, will slow quite sharply, maybe even potentially go into recession towards the end of the year. But there's a long way to go, and he can change his mind, as we've seen, on a sixpence.
Yeah.
So crystal balls are quite tricky to find, but uncertainty is there, and I think it's important to say two things. One, the portfolios are set up to be diversified for just this sort of environment. If you look back every year, there's always an event. There's an unusual event, but we've always have uncertainty in markets. And the other thing to say is that we're able to change these portfolios to reflect that. So we will make those changes, and we've already made some changes this quarter, and we'll make more if necessary.
I think just a minute ago you just touched on diversification, and that was a key word in the investment committee meeting that we've just come out of. Maybe just explain what that means in simple terms to clients in terms of being diverse as much as we possibly can across our models.
Yeah, 100%. So when we talk about diversification, we're talking about spreading risk, exactly as we've described. So that means spreading risk across different asset classes. So across equities, across fixed incomes, across bonds, across some alternatives as well, some different strategies that are a bit different to those two areas. It means spreading risk across geographies. So not having all of clients' investments in, say, the US equity market, investing across different regions for both the US and other developed markets and emerging markets. It means within fixed income investing in both very safe and secure markets, such as government bonds, short-dated government bonds, which are basically like cash, but all the way up to more risky fixed income, which sometimes can be a very strong source of return. So we have this ability to spread the risk And what's important about that is not only are you spreading lots of eggs, not putting all your eggs in one basket, but also they move at different times. And so there will be times when equities struggle because of uncertainties, when you see that on the headlines where the equity markets are falling on the day, but where other parts of the portfolio are actually rising on the day, and those help to offset each other to some degree and to dampen that risk. And so diversification is absolutely critical. And the three-pillar approach and the mix of assets is the way we achieve that.
Well, it's really good to see that our clients are in safe hands through these tricky periods of investment volatility.
Yeah, well, I think these are uncertain times. They are uncomfortable for all investors, but we've all been through these cycles before. And what's, I think, critical is these portfolios are very well diversified, very well spread, to try and limit the volatility in these uncertain times.
Thanks very much, Will.
Thanks very much, Paul.